Ladies and gentlemen, welcome to Cummins India Limited conference call. The call will begin shortly. Please stay connected. Please note that you have been connected to Cummins India Limited conference call. The call will begin shortly. Please stay connected. Good morning, ladies and gentlemen. Welcome to Cummins India Limited Q2FY25 earnings conference call. We hope you all are keeping safe and healthy. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the commentary concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I will now hand the conference over to Ms. Shweta Arya, Managing Director, Cummins India Limited. Thank you, and over to you, ma'am.
Thank you. Good morning, ladies and gentlemen. I hope all of you are doing well and staying safe and healthy. Welcome to the Cummins India Limited Q2 financial year 2024-25 earnings conference call. I am Shweta Arya, Managing Director, Cummins India Limited. Joining me on the call today is Ajay Patil, Chief Financial Officer of Cummins India Limited. Thank you all of you for joining us today. Now I would like to share the financial results of Q2 financial year 24-25. For the quarter ended September 30, 2024, with respect to the same quarter last year, our sales at 2,444 crores are higher by 31%, compared to 1,871 crores recorded in the same quarter last year. Domestic sales at 2,008 crores are higher by 47%. Exports at 440 crores are lower by 13%. Profit before tax at 594 crores is higher by 39% compared to the same quarter last year. For the quarter ended September 30, 2024, with respect to the previous quarter, our sales at 2,448 crores are higher by 8% compared to 2,262 crores recorded in the last quarter. Domestic sales at 2,008 crores are higher by 7%. Exports at 440 crores are higher by 13%. Profit before tax at 594 crores is higher by 8% compared to the previous quarter. I would now like to share the segment-wise sales breakup for the quarter ended September 30, 2024. For the domestic business, power generation domestic sales were 896 crores, 84% higher compared to last year and 12% higher compared to last quarter. Distribution business sales were 658 crores, 20% higher compared to last year and 1% higher compared to last quarter. Industrial domestic business sales were at 406 crores, 35% higher compared to last year and 9% higher compared to last quarter. For the exports business, high horsepower exports were at 200 crores, 24% lower compared to last year and 1% lower compared to last quarter. Low horsepower exports were 198 crores, 5% lower compared to last quarter and to last year and 28% higher compared to last quarter. Cummins India financial guidance. Regarding the sales outlook for the full year 2024-25, we expect to have double-digit revenue growth over the fiscal year. That's it from my side. I now open the session for questions. Thank you.
Thank you very much, ma'am. We will now begin with the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, hi, Shweta. Congratulations on a great quarter. Ma'am, my first question is on the pricing of the CPCB 4 Plus engines. So now we have almost 2 quarters now, and so from the starting point when you had introduced these engines, and then there was a deferral. So from that point to this point, have you seen any correction in prices?
So you're right, CPCB 4 Plus was announced last year, and then we transitioned to full CPCB 4 Plus this year, 1st of July. We are watching this space. We had launched our products last year. We are seeing all the other products from other players getting launched now. And so I think we will see what happens to pricing in the coming 2 quarters. That's how I would think this will play out in the next 2 quarters.
But your own pricing, when it was introduced, the engines was introduced until now, so have you seen any correction in price, or are you still maintaining those prices?
We are mostly maintaining those prices as of now.
Okay. And the second question is on the nodes. I think you have some advantage. You have more nodes in the market versus the competition, and now you said that more nodes are coming in from the competition. So do you think you have some fair advantage because you have more nodes in the market, and hence you are able to capture a larger share of the market? And as competition introduces more product, do you think that potentially there is a case that you may lose some of this market share gains?
I would say that customers will now have more choices in the market, for sure. We were amongst one of the first few players to launch the full range of products in the market. In the meantime, we have continuously worked on improving our supply chain, making sure that our product is well accepted in the market. We do have a strong brand in the market. So we do think we are pretty well positioned in the CPCB 4 Plus space in the market.
Okay. And what will be the differential between the competition prices and our prices in the market now?
We are watching the space. Pricing will play out, in our view, in the next few quarters. We have seen products getting launched, so we are watching the space.
Okay. This is the last question on the exports market. Now, this is the 4th consecutive quarter of recovery in exports. If you can help us understand the demand from the end markets and which geographies have recovered, and how do you see this demand panning out for us today?
So from an export perspective, specifically speaking about the quarter that went by, we saw some good orders coming in from Latin America and from Europe. The Middle East, Asia Pacific, Africa regions remained muted. So these are mixed signals. There are geopolitical situations around us. We provide our products to a wide range of countries. So we do see mixed signals. But for the quarter gone by, we definitely saw great orders coming from Latin America and Europe region.
Okay. Sure, Shweta. Thank you. Those were my questions, and wish you the best.
Thank you. Thank you.
Thank you. The next question is from the line of Shubhadeep Mitra from Nuvama. Please go ahead.
Good morning, and thank you for the opportunity. Congratulations for an excellent set of results. My first question is what we're trying to understand is, out of the overall 2,400 crores of top line that you have come up with, what rough percentage of that would be CPCB 4 sales?
Thank you for the question. Thank you for I can share with you that in the domestic power gen market, out of the 2,448 crores, the overall domestic market number I shared with you at 2,008 crores, of which our power gen number is around 896 crores for the quarter. That is power gen, and the mix continues to be in the last quarter, mostly CPCB 4 Plus, some CPCB 2, but mostly CPCB 4 Plus. As you will understand, CPCB 4 Plus is below 800 kilowatt, and above that is CPCB2 range. So there is a mix there of CPCB2 and CPCB4 plus.
Understood. Secondly, I think in your parents' commentary for this particular quarter, it was mentioned that there is still some lingering benefit of CPCB2 pre-sales. So has there been any CPCB2 related pre-sale benefit that has still continued in 2Q?
No. CPCB pre-sale is all over, and we flushed out all the inventory now. So in this quarter, there is no CPCB2 pre-sale benefit.
Perfect. That is understandable. Secondly, just wanted to understand that in this particular quarter, clearly gross margin numbers have seen a bit of an impact. Is this largely because of higher import component that we're seeing for CPCB4?
No, this is largely due to the mix that plays out for us. In this quarter, there is a large share of the projects business, as we call it, where we do installation and commissioning for some of our gensets in the and so because of that, it's the mix playing out.
Understood. So you anticipate gross margins to kind of revert back to normalized levels once this project business execution is done?
It's the regular part of the business. Projects business continue for us, as do the other sales. So there are some quarters where we do larger share of that kind of business. We do sometimes larger share of the other sales. So it's a continuous part of our business.
Understood. Last question from my side is, I understand there is a good component of operating leverage benefit also, which would have probably come in this quarter, leading to these kind of EBITDA margins. So would you believe that this range of EBITDA margin can continue, and what kind of capacity utilization are we sitting on right now?
So from a margin perspective, we've been putting continuous efforts really. We do have good volumes. There are cost management and material margin improvement programs that we continuously work on. So all of that is ongoing work for us, which is mostly to provide the right value to our customers in the market. And that is going to continue for us.
And in terms of capacity utilization, any number you would like to talk about?
There's a wide range of products that we manufacture in our plants. And our capacities are utilized quite well at this point in time, on an average, more than 60 to 65% utilization.
Understood. One last question I'll squeeze in, that in terms of data centers, is there a large potential market that you're looking at, and what quantum of your sales would data centers comprise?
Data centers around the world as a segment is doing very well given the AI boom across the world, as is the case in India. And we have products which are rightfully positioned for that segment. So most definitely we are quite focused on that segment, and we see the growth of that segment around the world as we see it in India. So that's where we are with data centers.
And any particular percentage of sales today that you're seeing data centers comprise of?
Not really. Data centers is spread across. We don't give specific segment-wise information. And in data center space, we do first fit sales as well as we do some project work. So it's spread out across different kinds of work that we do. So we can't share that segment-specific information.
Understood, madam. Thanks so much for answering my questions.
Thank you.
Thank you. We'll take the next question from the line of Jason Soans from IDBI Capital. Please go ahead.
Yeah, ma'am. Thanks for taking my question. Congrats on taking charge on your new role. I would just want to ask you the first industrial segment business. Now, I believe in January 2025, there is a emission norm change for the construction equipment industry in terms of engines. So are we looking in the Q3 quarter for some pre-buying? Could you give some color on this aspect in terms of the emission norm change? How are we playing, and how are we getting ready for this change coming along from January 2025?
Thank you. Thank you for your question. Yes, there will be an emission norm change in that segment. The construction segment, from a demand perspective, has been doing well. So in the quarter gone by and in the coming quarter, given the construction activity going on in the country, as it is, the segment has been this particular space has been doing well. As with any other emission change, there is some pre-buy that happens in the market, plus the demand is strong. So there would be mostly some pre-buy before the emission change, as happens in every segment.
Sure, ma'am. Oh. And so I also wanted to understand, I mean, I understand
sorry,
the earlier...
Sones, your voice is breaking, sir.
Hello?
Yeah, can you come in the network area? And there is a background noise as well from your end.
Hello? Is it better now?
Yes, sir, much better. Please continue.
Yeah, sure. I will I'll try and continue. Yeah, so I just wanted to ask, I understand that an earlier participant did ask this question. Now, just wanted to understand this the gross margins dip, which happened as it's around 220 bits on a console basis. So just wanted to understand, you did explain about the larger share of the project. Could you just explain a bit, could you throw some more color on this? And also now, since we have completely shifted to the CPCB 4+ regime, what could be sustainable things going forward for Cummins?
So I did explain this, that this did happen due to the mix of the products, and it's a continuous part of the business. Other than that, there is nothing specific in this space, and there's just continuous work going on improving our material margins, which is an internal program called ACE that we run. Other than that, there is nothing unusual here than the mix. So, which plays out based on how we get those projects and how we execute them, as I mentioned earlier.
Okay, sure. Then those are all my questions. I'll join back with you. Thank you so much.
Thank you.
Thank you. We'll take the next question from the line of Umesh Raut from Nomura, India. Please go ahead.
Hi, ma'am. Good morning. Congratulations for the strong domestic performance on sales side. My question again is more on the gross margin side. So if I look at overall mix for the company on a quarter-on-quarter basis, even on a year-on-year basis, I think it is largely remaining same. But we have observed about closer to 200 basis point gross margin drop on a quarter-on-quarter basis. So is it primarily because, in your view, whatever cost increase that was there on the CPCB 4+ product side, that is fully not yet passed on to the customer, and that is how incremental CPCB 4+ product line is kind of impacting on the gross margins for you?
Thank you for the question, but no, that is not how it is playing out in the gross margin. The gross margin, as I explained, is mostly a function of the mix, really. So that's not what's playing out.
Got it. Thank you for that clarity. Second question, when you are saying that project business contribution for this quarter was relatively on a higher side, are you referring to project business which is coming under industrial segment or any particular project order that you have received in the power generation side?
This is a separate business. This is not from the industrial business. This is execution of sites at the data center where we do installation and commissioning of heavy genset applications tailored to the customer's demands. So that's what this project's business is.
Got it. I'm sure your restructuring exercises like VRS and all, they have contributed in controlling employee cost for you. But for this quarter, we have observed more of about flat employee cost on a year-on-year basis. Any reason over here? What kind of employee cost trend we can assume going forward?
I'll request Ajay for you to take this question, please.
Hi, Umesh. Thank you for joining the call. I think the function of what you see on the people cost has some amount of one-off item impact that has played out in the quarter. There were certain reclassifications that we reported. So therefore, the numbers seem flat when you see it on a year-on-year basis. However, when you see it on a YTD basis, on a 6-monthly basis, you will find our people cost has the impact of one-off plus the merit. So overall, you should expect the people cost to inflate at a normal rate what you have seen historically.
Okay. Could you please quantify the number for first half or for this quarter?
There was some one-off adjustment to the tune of about 42 crores.
This is for the quarter, right?
Yeah, quarter and YTD, both.
Okay, got it. And is there any one-off on the other expenses side as well in the quarter? Because we have seen about 32% jump in other expenses as compared to 31% sales growth. Was there any promotional expenses around new product launches related to CPCB4 Plus?
No, I think the other expense, Umesh, is a function of how the volume has played out for us. As you would have seen on an H1 basis, the revenue is up 16%. So obviously there is an impact of some volume-linked variable expenses there. Besides, some of the reclass that we talked about has some impact flowing through the other expense as well. And plus, of course, there are certain investments that we have made when it comes to our front-end infrastructure on how we serve the customer. So some costs associated with those technology expenses, those are coming through in the other expense.
Got it, sir. Thank you so much. I'll join back the queue. All the very best.
Thank you.
Thank you. We'll take the next question from the line of Mahesh Bendre from LIC Mutual Fund. Please go ahead.
Hi. Thank you so much for the opportunity. Ma'am, what is the currently capacity utilization in our genset factory in terms of engine manufacturing facility?
Yeah, Ajay, would you like to?
Yeah, I think Mahesh, the way the capacity utilization has to be looked at it is in two parts. One is on the manned capacity side, we are in excess of 90%. However, when you look at our installed capacity, relative to that, we are about 60% or thereabout. So from a capacity availability point of view, we have ample capacity available in order to address any potential uptick that will come.
Yeah. Thank you, Ajay.
Yeah.
So basically the waiting period for genset has gone up?
No, the waiting period for genset has not gone up. We are maintaining our lead times. In fact, we've been able to work on our supply chain and we have been able to improve our lead times.
Okay. And so last question from my end is about distribution side. I mean, this business has been doing really well, 20% growth. So how should we look at in terms of the genset population we are currently addressing? I mean, if someone has to imagine about the business in terms of growth, how should we look at this?
So this is a parts and service business for us. And where we are focused on is increasing the penetration with our customers across the board. And we continuously provide service contracts as well as parts to our customers for them to be able to maintain their assets over a long period of time. So our endeavor is to provide that right kind of maintenance and the right kind of value adds for the customer. And that's how this business has been growing for us, and it continues to be a focus area for us.
So the genset, as long as genset population grows from our end, this business will continue to build up, right?
So the genset population growth, our penetration with the customers, both of those help with growing this business.
Sure. Thank you. Thank you, ma'am.
Thank you.
Thank you. We'll take the next question from the line of Priyankar Biswas from BNP Paribas Exane. Please go ahead.
Congratulations, ma'am, for your new responsibilities. So my first question is on the power gen side. If I recall, in the last con call, what we heard was that there was a lack of channel inventory for CPCB4 because there was a lot of pre-buy. So what is the inventory level at the channel right now? And also, parallelly on that question, I would add on one more thing is, what I understand is that most of the players are offering 2 years comprehensive warranty and then on top of that 3 years critical parts warranty. So isn't it going to lead to higher warranty provisionings at your end in case if you are following the same trend? So that's my question.
Okay, thank you for the question. I'll first answer the inventory question. We continuously evaluate inventory in the channel, and for CPCB4 Plus as well. We have evaluated the inventory and we are at adequate stock availability in our channel for CPCB4 Plus. So that's where the inventory levels are. In terms of your question around warranty, this is a very, very careful calculation at our end, where we work through what does the customer need, how can we provide the best value to the customer, and that's how we provide them these kind of warranty options. This does not lead to any excess provisions. It's the usual course of business, and we have quantified that in our books as well.
Okay. And then one more question, currently that I have is recently what we are seeing is that at least from the data shared by ISEMA, that the construction equipment sales growth has been falling. For example, in 4Q, what used to be 21% is now like 1% construction equipment sales growth in September. So how confident are we that our construction segment or the industrial sales will continue on their growth momentum?
We have seen strong demand from our customers in the construction segment. So that's we do think that this space will show demand in the coming quarters as well. So we have not seen any other signals yet.
Okay. And then finally from my end, the usual breakup of power gen like HHP, mid-range, LHP, and for industrials like mining, construction, those numbers if you can share.
Sure. Let me share the power gen sales numbers. So for high horsepower for the quarter, we saw 452 crores of revenue. For MHP, 178 crores. For LHP, 199 crores. And for our projects business, around 68 crores. That's the total breakup of power gen. For the industrial business, the breakup into different segments. Construction is 146 crores. Rail, 105 crores. Mining at 32 crores. Compressor at 58 crores. And those are the major segments that we operate in.
Thank you, ma'am.
Thank you.
Thank you, ma'am. The next question is from the line of Nidhi Shah from ICICI Securities. Please go ahead.
Hi, thank you for taking my question. Just on the case participant's question, you gave us the breakup for power gen for domestic. Could you also provide the breakup for export?
Yeah, let me share that with you. For the exports, the high horsepower exports for the quarter overall, 200 crores. And the low horsepower for the quarter is 198 crores spread across the different geographies.
All right. Thank you so much.
Yeah, thank you.
Thank you. The next question is from the line of Vinod C. from Phillip Capital. Please go ahead.
Yeah, hi. Good morning and congratulations on your first quarter. I had a question related to data center. So what will be our market share in our addressable market in data center? And, parallel to that, backup is non-negotiable in data center. So are we able to command better pricing in data center sales compared to our regular sales?
Thank you for your question. As I mentioned, data center is a focus segment for us. It's a growing segment. We are rightly positioned with the correct product in this market. We have good relationships with all our customers. As you rightly said, backup is very important, as is customer service in this segment. So through both our businesses, we are very well positioned in the data center market to provide the value that our customer needs.
So are we seeing better pricing in data center compared to what we normally realize in the market?
We are always very competitively priced in the market. And data center, as any other segment, also, there's obviously competitive pricing in that space as well. We are priced adequately.
So what would be our market share there?
We won't be able to share the market share information, but I can tell you that we are very well positioned because our products are very well accepted in the data center space, and we provide the right kind of service to our customers along with the value adds that specific segment needs.
Sure. So second question was on exports. You've been mentioning for the past 1 year that India has the highest standards of emission norms, and if my engines are passed in India, it can be sold anywhere. So where are we on that? In terms of making India a hub for CPCB4. And at least since you spearheaded the CPCB4, probably you're apt to answer that.
Yes. Thank you for that question. So CPCB4, if you see, these are rightfully amongst the most stringent norms across the globe. We do have that technology. There are certain markets who are at these kind of emission levels, and there are certain markets that are not. As markets transition and as they require these products, we are ready with the technology. As we speak, we are tailoring our products for the markets which are getting ready to be able to provide this technology to them. So as and when the markets move, we move and we are able to provide this technology to them.
Sure. Thank you. Thanks for the reply.
Thank you. The next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Thank you for the opportunity, Shweta. Congratulations for the new role. I'll move to my questions. The first one being, was there any positive benefit that you had in the power gen segment because of at least shocking that would have happened for CPCB4 products? Or can we assume this run rate?
We can't hear you clearly. Could you please repeat your question?
I'm sorry to interrupt, sir. Your voice is muffled. I would request you to use your handset, please.
Is this better now?
Yes, sir. Please continue.
Great. So the question that I had was there any positive effect on the power gen sales because of restocking that would have happened for CPCB4 compliant products? Or can we assume this run rate incrementally as well?
Sorry, we're still unclear. The voice is still slightly muffled. You're asking about CPCB4 plus restocking?
Yeah, in the sense that as you flush out CPCB2 products and go for CPCB4, was there any inventory filling that led to a higher than usual number in power gen?
Okay. No. We had flushed out all the inventory before 1st of July. So there is no impact of CPCB2 inventory in this quarter.
Understood. The second question that I had was more on your assessment of the market share gain that has happened for you prior to and now post CPCB4 in the power gen segment as a whole. If you could give us some sense on that.
So in the power gen space, I will tell you in the CPCB4 plus range, we launched the product last year. And we have managed to make a lot of improvements in our supply chain till then. We have been able to, our product is exceptionally well positioned. We have a great brand in the market. We are pricing competitively, and there is good acceptance of the product in the market. That is the CPCB4 plus range. And in the higher ranges, we have seen, because our products are well positioned in the high horsepower range, so we have seen that our market presence has remained stable over the last few quarters, and we have been able to maintain good value to our customers. That's what I would be able to say.
Understood. I just want to move on to the data centers piece because I think it's important to understand for all of us. Now, if we see the global companies' power gen sales, it seems as if data centers command almost a 40% salience inside the power gen number, and they count the distribution piece of power gen inside. Could you give us a sense whether it's a good way to think through the mix of power gen in India for Cummins, maybe 3-4 years down the line?
Global markets and India markets are quite separate in their demand drivers and what drives the market. Different countries are at different spaces in terms of their backup power needs and how data centers are progressing. So I will not be able to say that we can draw a parallel right away with those global markets unless we can really analyze them with how similar they are and how similar India will be to some of those market signals.
Understood. Just a related question, and maybe I'll fall back into the queue. Basically, if you see globally, this phenomenon of hyperscaler data centers are becoming more and more prominent, and these customers typically are probably better served by Cummins because Cummins owns their own kind of distribution network as well, which I think is of importance in this kind of segment. Should one thus be assuming that as share of these kinds of customers goes up, the market share that Cummins would be having in the data center segment, and potentially the distribution revenues also start scaling up?
I will only say that Cummins has good technology, well-accepted product, and really good service and relationships with these customers. That being said, the data center is absolutely a growing market in India, and us as well as others are present in this market. We do have a great brand presence and great relationships with our customers.
Can that lead to an export kind of number happening, the data center market as such? Can that lead to an export number that starts becoming relevant over time? That will be the last question. Thank you.
Data centers across the world, the nodes at which they operate are not similar. India operates at a different node, and in the other markets, these are slightly higher nodes at which data centers operate, what they buy. So there could be, but there are, these are different nodes as we speak.
Sure. Thanks a lot for the responses. Thank you. Those are my questions.
Thank you. The next question is from the line of Amit Mahawar from UBS. Please go ahead.
Yeah, thank you. Hi, Shweta. I just have one question, and I'm sorry to harp on the competition and domestic market point. Post the new nodes, the competition eventually will catch up. But do you think this time on gensets up to 800 kVA, the competitive intensity will make us command the market share similar to what we enjoyed in the older nodes? And more importantly, because this time seemingly competition is taking more time. So 3-4 of our key local global competition are yet to see the acceptance of even higher nodes, particularly in data center or advanced nodes. So do you think the market share will stabilize even in the data center piece of ours by next year, or it will still remain around 70-80% plus market share, which earlier in the calls we had shared?
So the data center space is outside of the CPCB4 plus space. CPCB4, as you rightly said, is up to 800 kilowatts. So if we were to talk about the CPCB4 place, we were amongst the first few to launch this product about a year ago across the nodes in the power gen market. And I did mention that our product has good acceptance, and we have been able to make a lot of improvements in our supply chain and provide better value adds to the customer. Definitely, our customers have more choices now with other products being launched in the market as well. So that's with respect to your specific CPCB4 plus question. Data center is not a part of the CPCB4 plus range. And I did answer the data center question that we definitely see the demand in the data center market to continue, and our product is very well positioned along with the relationships that we have with our customers.
Okay. And just a clarification to the last participant's question. Did I hear it correctly? You mentioned the manufacturing of data centers led product and being manufactured is particularly fit for India. It is not for the global markets. And I'm also asking this question because some regions saw very strong growth, like China doubled, in power gen revenue this quarter. So did we have any export benefit there? Thank you.
So in case of the data center market, the product that we have for the data center market, India, China, Southeast Asia actually use the same product. It's the US and the UK which use different nodes in the data center. So definitely we export to those kind of markets which use the same product in the data center space.
Sure. Thank you, Shweta, and good luck.
Thank you.
Thank you. The next question is from the line of Jonas Bhutta from Birla Mutual Fund. Please go ahead.
Hi, Shweta and Ajay. Thank you for the opportunity and congratulations on a great set of numbers. Shweta, congratulations on the new role. A couple of questions from my side. Firstly, if you can talk about volume growth in the power gen side. While we understand this quarter sort of benefited from a lot of restocking of CPCB4 plus engines at the dealer end, for the year as a whole, do you expect volumes in the power gen to grow? Given that what we see as revenues is a function of price and volume, and prices are up 25-30% for this year. So how should we think through volume growth, particularly in power gen, with a backdrop that last year, FY24, saw 40% growth in megawatt terms in the power on the generator sales side, which is what is reported in the annual report. So that's the first question.
Thank you, Jonas, for the question. Ajay, do you want to take the volume question?
I'll take. Jonas, as you know, for last year, the original date for migration to CPCB 4 was July 1st of 2023. And at the last minute, that date was shifted to July 1st, 2024. The consequence was that we had a pre-buy in Q2 of last year, which was quite significant. And that's the reason when you see it in unit growth perspective, the FY23-24 numbers were to the extent significantly higher than the year before. Now, obviously, from a current year that the migration was clarified, the 12 months that you see from July till this June was a combination of both sets of products getting sold in the market. So obviously, the one-time effect of that pre-buy had an obvious impact on the subsequent quarter, and all of us have seen those numbers softening on an expected line last year. Now, if you take that sort of a phenomena out, our belief based on when we see the unit volume growth that is playing out for the year to be consistent with what we see the broader guidance that we have been generally providing in terms of how do we see the growth is panning out for the year. Number one. Number two, price that you talked about is really a function of how CPCB 4, because we were among the first to get our product readiness in the market, and then the other players progressively catching up would mean that the price discovery is still playing out. Now, whether that price discovery process goes on for another quarter or more, our hypothesis is that maybe it will go on for up until another 3 to 4 months. So maybe that's where the clarity would start to emerge. So when you see the revenue number, as you rightly pointed out, I think it's a function of what is happening on the unit side. B, what is happening to the price. Obviously, there is a price change because we are talking a transition from mechanical to electronic engine. And number three, also there is a content increase. The configuration of a CPCB 2 genset and a CPCB 4 genset is very different. Given the emission requirement, we have new products which are after treatment and many other electronic components getting added. So the 2 and 4 product is really not comparable. So when you put these two things together, you will have to look at this current year more of a transitionary year in terms of these changes playing out before we can very clearly state as to what the unit growth volume is and what the pricing impact is.
Thanks, Ajay.
Now, just to follow up on this, Ajay, so just to close this out, is it fair to say that on a normalized basis this year we'll still see a 2x GDP volume growth? Pricing will obviously yield it a higher ultimate revenue number, but are you on track to do a 2x GDP volume growth this year? Is that what is the market is supporting?
I think that since your question is linked to the guidance, Jonas, I would just reiterate what Shweta said at the start of the call, that we continue to maintain our double-digit guidance for the year. On the revenue side, volume is a little bit of a difficult one to see because we are not giving guidances on volume. And you also have to remember that the volume also has a shifting sands in it, because the way the volume gets computed, depending on which segments you talk about, for example, telecom, there is a large volume unit growth at a very low end of the market goes into that segment, which kind of reshades the number when you think about the volume growth. And because it's a tender-driven business and we participate very selectively into it, that can change the dynamics of what unit volume we had in the previous year compared to what unit volume we have this year. So therefore, I think this year is going to be that way difficult to compare given the sort of hybrid transition that we did, where we had two emission products playing out in the same year. It generally doesn't happen because there is generally a clean cutover taken for emissions, but because this has been a sort of a mixed bag, when we are selling both the products up until 30th of June, that unit growth is going to get little bit impacted as a result of how the emissions are implemented.
Sure. That's helpful. The second question was on the value addition on the CPCB 4 Plus engines, and Ajay, you alluded to the fact that there is a content change, and most of that content, typically is going to come from group entity, which is on the SCR side. Given now 2 normalized quarters on CPCB 4 Plus, do you still hold on to this view that the gross margins on the 4 Plus engine is similar to the 2 CPCB 2 engines, despite a higher component coming from outside the listed entity?
Yeah, so Jonas, I think the question is, and we have already stated that, right? I mean, when you think about the content change and the way it is playing out, the current year's revenue has a combination of both the products. Okay. Number 2 is that as we now take a clean cut from July onwards, then we will have, so to say, a revenue which is predominantly driven by CPCB 4 into our revenue profile. Number 3 is the mixed part, which was explained by Shweta earlier for a different question, is also how the mix plays out overall. Because just to remind all of us that the emissions are only up to 800 kg. Above that, which is predominantly an HHP segment, continues to be operating at the old emission norm. If that plays out stronger for any reason, then to that extent the overall revenue number would be then looking different as to how the year plays out. Number 3, from a supply chain question that you asked, I think we continue to sort of optimize, and as you rightly said, now that we are operating for a period of time, our supply chain optimization is a continuous process. And because we are an engineered product, even if we see a cost reduction opportunity, we are not able to deploy it immediately unless it is clear from engineering point of view. And that process of validation takes time for us. So an opportunity identification, getting the opportunity realized, and getting a sign-off typically can take anything between 3 months to 6 months for us. So some of this cost optimization effort, you will continue to see reflecting into our margins as we go forward. And the quarter-on-quarter numbers, Jonas, as all of us know, has an impact of mix. And therefore, I'm not giving a guidance or anything, but simply saying that generally a full year number or a half yearly number is a better representation in terms of how the figures look like.
And the last quick one, I know many questions were centered around data center, but Shweta, like you said, that there is a node difference between developed markets and developing markets. But typically, as the scale migrates, today developed markets are setting up 100 megawatt data centers, single location, and probably at some point in time this migrates to India over the next 2-3 years. Indian entity, because what we understand, the QSK60 and the QSK95, which are the predominant nodes used abroad, sit in CTIL. So from a clarification perspective, would appreciate that while the sales is routed through CIL, which is the listed entity, the manufacturing for QSK60 and 95 currently sit in CTIL.
So, Jonas, QSK60 is the predominant node in the data centers in India and Southeast Asia. And for the global markets like US and Europe, the predominant nodes are QSK78 and 95. Now, we've been watching the data center space, and as you rightly said, we were also thinking that probably the data center nodes in India will move up in the range. But for now, data centers is a very space-constrained space in our country still. Where you see the data center clusters in India, in Mumbai, in Hyderabad, in Gurgaon, in Delhi, these are still space-constrained cities, which is unlike the global markets. So for the India market and predominantly the larger Southeast Asia market, QSK60 continues to be the predominant node, which is a very, very robust node made in India and for made in India for the rest of the world as well. So As of now, we are not seeing a migration towards the higher nodes for the India market, mostly owing to space constraints and also customers being very familiar with the QSK60 node and the maintenance of those equipments which have QSK60. So we are not seeing that trend. We are watching it very carefully for now. And as things change, we'll take those calls.
Just to clarify, does QSK60 manufacturing sit in CIL?
Jonas, QSK60, as we have stated in the past, is an exports program that got launched. And therefore, from a core manufacturing perspective, a significant volume of the QSK60 was for Cummins exports purposes. The domestic volume is fairly low. On its own, therefore, on a competitive side, CIL gets that engine at a certain level of readiness from CTIPL, does the subsequent value add in CIL, and then it gets, sold in the domestic market for various applications, including data centers.
Got it. Appreciate. All the best. Thank you.
Thank you.
Thank you. We'll take the next question from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Sir, thank you. Most of my questions are answered. And this is in continuation with Jonas' question. So we've had 2 consecutive quarters of about 800 crore plus revenue in the power gen segment, out of which second quarter clearly was only CPCB4 plus in terms of new implementation. Can we, for our modeling purpose, assume that this is now the new base to model next few quarters from here on, i.e., it has the impact of significant price increases in CPCB4 plus that you did not have a large portfolio of CPCB2 that got sold in the current quarter? And I'm asking this question because there's been a lot of noise and numbers in the past few quarters with meaningful price increases and pre-buying and so on and so forth. So between 800 to 900 crore in the last 2 quarters, is it the right number from a sustainability perspective, and we build our models based on that? Is that a right assumption?
I'll say 2-3 things here. The first is that from an overall market demand perspective, the market continues to show demand in the power generation space. The second, the numbers are not completely just CPCB4 because CPCB4 plus is applicable only up to 800 kilowatt hour or the 910 kV range. Above that is CPCB2. So both these in different ranges continue and contribute to the overall power gen segment sales. Now, the third thing around pricing, Ajay mentioned, we are seeing this was the first quarter where we saw full CPCB4 plus, and we do believe that pricing will take some time to settle in the market, at least 3 to 4 months. So, the demand, the pricing, the mix between below 800 and above 800, which can change given where the demand is driven. So higher, if we are selling in the higher than 800 kilowatt hour range, that is more the CPCB2 product, and then below is the CPCB4 plus product. So those will continue to play out really and could give us different results.
No, I think all the 3 points are well taken, and that's exactly what my question was. Thank you for that.
Thank you.
Thank you. We'll take the next question from the line of Sanjay Satpathy from Ampersand Capital. Please go ahead.
Thanks for the opportunity. Can I just ask what is the level of indigenization in your CPCB4 gensets? And what is the scope of improvement there?
So in the CPCB4 plus product range, you will appreciate that we are a global company and we do take advantage of technology and products from around the world. A large part of our CPCB4 plus product range and what goes in those products is localized, and we are continuously working on where we do not have indigenized parts yet. So it's a continuous endeavor, but I can tell you that a large part of that product range is already localized at the time of launch.
Understood. And does this mean that the scope of margin improvement is not much from current level?
I do think margin will be a factor of various things. Other than localization, there are other cost reduction efforts that we take, which is around value engineering. Ajay was explaining just a while ago. We are continuously working across all CPCB 4 Plus products, even those that are localized today, on cost improvement programs. And that plus the pricing settling in the market. So margins is actually a function of those two. So can't say it only depends on localization efforts.
Understood. And last thing, if you can just tell us, like a bit in the gensets, which is like over 800 crore for you, how much would be data center related and how much would be non-data center? Is that something which you can share?
That is very segment specific.
At least how much is more than those 800 plus capacity, that mix of that?
We won't be able to share that. And like I explained earlier, data center sits in the projects business for us as well as in the actual sale of the product, both different places. So it's difficult to tell you really what would be our presence in that space.
Got it. And can you just also understand from your perspective, like the previous instance of this emission change was a little bit more disruptive for the industry and the demand took a lot longer to settle. But this time around, the implementation has been a very different way. That is one staggered 1 year. So should one expect the normalcy to return to the industry much quicker and the pricing discovery will be faster than what had happened in the past? And also related to now that you are like in globally benchmark in terms of emission norms, shouldn't one expect a much better export prospect for your company?
So on your first question on whether the market will settle quicker, obviously everyone has learned through the last emission change, but how soon will we settle in the market is difficult to say. Will it be quicker than the last emission norms? Difficult to say. All I can say is that everyone has learned through the last emission cycle, and we all had 1 year also to learn on how the product is doing in the market. On the export side, I did answer this question earlier. Yes, we definitely have the technology. We are looking at different markets, some of the markets which need our product, and we can tailor our products for their specific requirements. That work is going on. And for other markets which would move to this emission norm, this is one of the most stringent emission norms around the world. So there are not many markets which are on this level of emission norms. But we closely monitor that, and as markets move, we are ready to provide the products for those markets. And you will appreciate that for each different market, while the core technology is there, the products need to be tailored to suit the local market requirements. So that is the work we are doing currently for some markets which need these products and watching the other markets closely.
Got it. And as we know, like last year, December quarter, you